Okay, wonderful. So hi folks. I hope everyone is doing good. Welcome to this session on portfolio management. Here's the agenda for today's session. It's going to be roughly 2.5 to 3 hours. The target is that by the end of the session, we want to understand this brilliant concept called efficient frontier by Harry Markowitz, which sounds fancy right now, but I think in a couple of hours time, you should feel comfortable with it. So the target is to learn the concept, also understand the framework and the background through which the concept was developed. Okay, this is roughly the target. This is a beginner level session, so I'm not going to make any assumptions. The only assumption that I'm going to make is that you're comfortable with basic concepts like mean and standard deviation and returns and all those kind of things. So if you feel that you probably also need to work on that, FinTree has a fantastic course called Level 0. It's a free of cost course for everyone. So you can sign up on the FinTree website, do the Level 0 program to work on your basics, and then you can again, come and do this particular session. All right. So with this background, I'm going to get started. Just allow me to share my screen here. Okay. Is my screen visible? Can you guys confirm on the chat box? Wonderful. So we have few participants who are attending this session on Zoom meeting link, and then we have participants who are attending this on YouTube as well. I would be monitoring. I will be monitoring both the chat boxes. So at any point of time you feel that you want to ask queries, you just throw in the chat box, and then I would try and answer them for you. Okay, so with this we'll get started. The first two words that I want to throw at you today are portfolio management. Okay. Now today, we kind of take this word for granted. Maybe most of us have some idea of how portfolio management works, but it wasn't always like this. Okay, there was a time when we used to look at money management from a different perspective, especially before 1950s and 1960s. As you guys might know, that finance is relatively new subject, right? Finance is, I mean, most of the modern finance that we study today, it's roughly 100, 150-year-old, type of concepts. So until 1950s or 1960s, the world of portfolio management was not evolved. Now, how do you want to think of portfolio management? Is very, very simple. Like, how do you look at things from a portfolio perspective? So let's say that you go out for shopping. You end up reaching to a store called Avenue Supermart. Have you heard of it? Correct. DMart, right? DMart. A lot of people know in India. I don't know if maybe I'll get hate for saying that, but it's kind of Indianized wannabe Walmart of sorts, right? And you go to the store, you see, wow, there is so much of rush. People are queuing in to buy this stuff. Maybe the business is doing good. Maybe I should buy the shares of the company, or I should buy the stock of the company, right? So what you decide to do is you decide to buy shares of, let's say, Avenue Supermart, and then you come back home. You're hungry, you don't feel like cooking today. So you decide, okay, fine, let me consider ordering food online. So you open up the food ordering app in India, which is called Zomato, and you order the food, and the food is delivered, and you're very happy and satisfied with the service. You're like, wow, this is a great business, it's creating value. So let me also buy shares of this company, right? And you decide to buy, allocate a little bit of money to Zomato shares. And there you go. You have 2 shares, 3 shares, 4 shares in your portfolio. Your portfolio is kind of ready, right? So the way you want to think of, the way you want to think of portfolio is it's basically a combination of different assets combined into one, right? Now, you feel that, okay, apart from equities, I want to have different asset classes. Like a lot of people in India are obsessed with one particular type of investment that almost every family will have investment into gold, right? So you throw in a little bit of gold, gold ETF or a physical gold or different types of gold investment. So there you go. You have different assets in your portfolio, right? You have a different asset class. Plus, you'd be surprised to know that we have a massive size of amount invested into fixed deposits. And fixed deposits are simply, deposits that you make with the bank. In the finance world, we call them fixed income. So you have some fixed deposits, and then that's your portfolio. So in a way, each one of us in some or the other form have created a portfolio ourselves, right? And there's a little bit of intuitive understanding that we have, even without knowing technical finance, that I should not put all my eggs into one basket. Like I should not take all my wealth and put that into Zomato, because you never know what happens tomorrow, right? Maybe Amazon comes, eats up the market. Right? There's a little bit of risk there. So what we decide to do is we put a little bit of money at different places. And in finance, we call that as what? You kind of not putting all your money at one place, but kind of putting it in different assets. We call that as diversification or diversification, right? So we say diversification, right? So what we're trying to do is, instead of putting all our money at one place, we kind of trying to diversify. Now, isn't that a very intuitive concept that we should do it? We should, right? But you'd be surprised to know that until 1960s, it wasn't so intuitive then, right? The concept of diversification and how diversification will reduce your risk was not understood as well as what it is understood today. And obviously, there was one man who I think was one of the main reason for this whole thing to this whole field to kind of change and evolve into what area it has become. The name of that gentleman was Professor, come on. Harry Markowitz. You're right. Professor Harry Markowitz. Okay. And he wrote a series of research papers. I think two of them notable for portfolio management work. So he wrote this series of research paper. And then there's one single English word that he used multiple times. And a lot of people, feel that the reason why that word became popular is because of Professor Harry Markowitz. Now, can you make guesses about what word that would be? Can you make some guesses about, what could be that word that he made popular? I'm getting different answers on the chat box. Komal is saying efficient frontier. Prasad is saying efficient. Preetham is saying time value. Tanmay is saying homogeneous. Market efficiency, portfolio. Come on, what do you think? What do you think was that word? ROI, efficient. Come on, what do you think was the word that kind of became popular? The word that that became popular. Sneha on YouTube says rational. Tanvi says diversification, Darwinian knowledge. Wow. All right. The word that became popular, and the word that is kind of the focal point of today's portfolio management space is called optimization. It's called optimization, right? And maybe this word is summarizing the entire session for us today, right? The entire portfolio management space is about optimizing the outcome within the constraints. right? We have constraints. Within that, we want to achieve maximum results. In fact, a few years back when I was doing some random search, I came across this really cool thing. So can you confirm if my browser is visible to you now? Okay. So we have this thing called the Google Books Ngram Viewer, right? And what this Google Books Ngram Viewer, essentially says, it shows popularity of certain words and the usage of these words over a period of time. Okay, so on the x-axis we have time, and then we can use different words, and we can see when these words have become popular. Okay, so give me some random word that comes to your mind. Okay, give me some random word, any word that you think is latest. Okay, all right, we'll check Bitcoin. We'll see when Bitcoin as a word kind of became popular. And look at this. It's an amazing tool, right? You can play on this tool the whole day. Bitcoin kind of picked up in popularity somewhere around 2008, 2009. And look at the graph, right? Look at the speed at which that usage of the word has increased over a period of time. So what I'm going to do now is I'm going to show you the Harry Markowitz research paper dates. Okay, so Harry Markowitz. Okay, we'll just see it on the wiki page just for the fun of it. So if you look at the research paper rates, let's see if we can find the dates quickly. Yeah, can you see there is a paper written in 1952? Then there's a paper written in 1952 again, and then there is a 1957 and 1959 papers, right? So this was the time when he was actually working on some of these concepts that we would be working on today. So 52, 52, 57, 59. What I'm going to do now is I'm going to throw in optimization into Ngram Viewer. Okay, so let's see what happens. Optimization, enter, and look at the graph. So the word isn't as frequently used in in this window, but see around 1953, 54, then a usage of this word shoots up, right? So of course there is no way to prove that he is the one who made the word popular, but the two dates kind of are ironical. I mean, we can conclude that maybe he was one of the reason why the word became more and more popular, right? So the focal point of today's session is going to be on the word optimization. Now let's build on to the story a little bit more. So what do you mean by optimization? What are we really trying to achieve here? What is it that we want to achieve? Okay. So what Harry Markowitz proposed in a very nutshell is, he was like, you should have a portfolio approach of looking at the things. Okay. And what do you mean by a portfolio approach? Let us say that there is a particular stock A, right? How do you and I look at it? We evaluate that individually. We ask ourselves, is it a good stock? What kind of return the stock will give me? What are the possible risks? Where can things go wrong? Maybe it's a good stock, let me buy it, right? That's how we do it. Now, when you're doing it this way, you're not taking a portfolio approach. Here is what Harry Markowitz proposed. What Harry Markowitz proposed is, he said, when you look at stock A, right? When you look at stock A, the way you want to ask, the right questions that you want to ask is that this is my current portfolio, okay, made of whatever number of stocks. Maybe your portfolio is made of C, D, E, F stocks. Now you're considering whether I should add this stock A to my portfolio, right? So the right questions to ask is not whether stock A is a great stock. The right question to ask is that when stock A gets added to my portfolio, what impact will it have on overall return and risk of the portfolio, correct? So my portfolio without considering stock A, my portfolio with stock A, is it going to enhance that risk return game for me? Because as long as I'm getting more returns for moderate risk, I'm optimizing it. That's definitely a smarter way of looking at things. And this is what, is portfolio approach in its essence. Okay. Now, the approach is highly mathematical. We would be doing tons of different sorts of calculation today. The first 30-40 minutes, I'm just building up for you so that someone who doesn't have a background should also be able to participate and understand the subsequent parts. So this is your portfolio approach. Now let's start doing some basics, especially from a calculation perspective. Okay. So first, let's say I have two stocks. Let's take two random names. Maybe in India, we'll take, let us say, HDFC Bank, one of the private banking franchise in India, which has made a lot of money for investors over a period of time. So we'll take HDFC Bank and give me one of your picks. Give me your pick. Don't give me Yes Bank, please. Don't give me a State Bank of India. Come on, give me something nice. Maybe like an IT company or a pharma company. All right, Asian Paints is a good choice. Asian Paints. All right, so a private paints company, again, has been a massive compounder. People have made tons and tons of money staying invested in Asian Paints for some time. Now we have these two stocks in the portfolio. The first question that we ask ourselves is, how much is the return that we can expect out of this portfolio, right? Expected return for 1 year. Now, how do you calculate an expected return? Is there a mathematical way of doing it? No, it's a guessing game, right? So you do your research, financial modeling, equity research, all that kind of stuff. But you try to make a very high probability guess of what we think would be the return between HDFC Bank and Asian Paints. So let's say the expected return on HDFC Bank is maybe, let's keep it at maybe 12%. Okay, 12% per annum. And Asian Paints, because we're seeing realty space kind of picking up. So maybe we might have a good year this year, maybe. So let's say 15 or 18%. So I'm going to keep it at 15. So HDFC Bank 12, Asian Paints 15. The next question you ask yourself is that if I have 100 rupees with me or $100 with me, how much of that money do I want to park in HDFC Bank? And how much of that do I want to park in Asian Paints? If I have 100 rupees, how do I allocate the money between the two? Now today, by the end of the session, you'd figure out a very mathematical, optimized way of doing it. Right now, I'm going to do it arbitrarily. So let's say that, we decide that I would probably go 60% of my money into HDFC Bank and 40% of my money into Asian Paints, right? So 60 rupees and 40 rupees. Now, if you have this much of information, what you can do is you can figure out what is the expected return of the portfolio. What is the expected return of the portfolio? That means on an average, on a portfolio level, what return do I expect to earn? Now, very easy way to do an expected return of the portfolio is to simply run a weighted average of these numbers. Okay, so what we're going to do is we're going to calculate a weighted average. How do you calculate a weighted average? 12% into 60% plus 15% into 40%. Okay, so what are we looking at? This is 7.2 and this is 6. So we are looking at 13.2% is the expected return of the portfolio. Okay, so this is our building block 1. Okay, the first fundamental concept in order to reach efficient frontier by the end of the session today, where we know how to calculate expected return. Now, can I use the same logic and do it for 3 stocks, 4 stocks, 10 stocks? Yes, same way. It works the same way. Okay, so that's how I'll simply do a weighted average. I'll get the expected return of the portfolio. All right, so this piece is out of our way. Now, continuing with the same example, I have HDFC Bank and Asian Paints, the second concept. I want to look at how risky, what is the level of risk that these guys are bringing into my portfolio, or these stocks are bringing into my portfolio. Now, Harry Markowitz defined risk very tightly. Okay, now risk could be defined in 10,000 different ways. But for Harry Markowitz, because he was trying to bring in algorithms into the calculation, there was a need for defining risk in a very tight, concise fashion. So for Harry Markowitz, the risk was defined in the context of standard deviation. Okay, so I don't know how many of you have heard this word before, but if you've heard, that's a good news. But if you haven't, it's fine. You'd learn now. Okay, now how do you want to look at standard deviation? An easier human language word for standard deviation is volatility. A pictorial representation of volatility could be something like this. So imagine we have two stocks, okay, and we are looking at the stock prices maybe, and then there is one stock which is which has a stock price. So if I put time here and if I put stock price here, okay, there's a one stock which has been kind of moving in a fashion like this, right? As against that, there is another stock, which moves like this. Okay, so obviously we have intuitive understanding on this. It looks like the first stock has a relatively more stable stock price profile. So intuitively we can say that it will have a less standard deviation. Now going forward, I'm also going to use the word sigma here. Okay, I'll be using this interchangeably. So I'll also at times simply call it sigma. So we can say this is less standard deviation, but it looks like it's more volatile. So this is a relatively higher sigma or higher standard deviation. That means this stock will become more risky, or it will be riskier, right? So in the context of Harry Markowitz, the risk was defined in the context of standard deviation. Now, you guys can always question this, right? So for example, if you've read literature on Warren Buffett, he says that standard deviation is not a risk because he looks at things from a different perspective. But because we're trying to bring in mathematical optimization today, we'll stick to the Harry Markowitz definition. We'll say risk is standard deviation. Okay. How to calculate that? You can look up, one of my basic videos on YouTube. I don't want to spend time on calculation of standard deviation. We'll just learn to use it today. Okay. So that's defined. Now, the building block 3 is how do you calculate? Building block 3, how do you establish a relationship between the two assets? Okay, so what does it mean? Think about it. Okay, you're going to be blown away once you understand what's happening in section 3. Let's say we have two stocks. We have a stock A and we have a stock B. Okay, and stock A is an extremely risky stock. Okay, it's highly volatile, very, very volatile. And stock B is also a risky stock. Okay, it's a very risky asset. It is also highly volatile. What I decide to do is I decide that I'm going to build a portfolio. Okay, I'm going to build a portfolio where I'm going to combine stock A and stock B together. Now, you tell me, what do you think? Do you think this portfolio will exhibit a very high risk or low risk, or we don't know? Both stock A and stock B are extremely risky portfolio. What do you think? What do you think would be the risk of the portfolio? Do you think it would be high? Bangalore people, those of you think high, just raise your hand. Those of you think that it will be a very, very high risk, just raise your hand. Let me see how many of you think it will be a risky portfolio. I just see a couple of hand raises. Okay, there are a few on the front rows. All right. So the answer is, and this is kind of, eureka moment for some of you. The answer is not whether the portfolio A and B is risky or highly risky or not. It is, not necessary. What I mean by that is combining two risky assets, okay, does not necessarily imply a risky portfolio. Amazing, right? Does not necessarily imply a risky portfolio. And you'd say, Utkarsh, that does not sound intuitive. How is it possible that we're combining two assets and the portfolio is not risky? So that kind of brings us to the concept of correlation. Okay, it's a statistical concept, the concept of correlation, but I'm going to kind of try to give you some sort of a visual on it so you'll understand. Okay, so let's build a graph. Let's build a graph and let's try to learn it more intuitively rather than doing it mathematically. Okay, so let's say that this is the stock price profile of A. Okay, so this is how A behaves. All right, so this is A. Let me bring in a different color, and this is the stock. By the way, all the people who are for the first time into the session, it's not mandatory for you to write. I share all these PDFs with you. So you can always scribble if you like, but as far as class notes are concerned, you'd get the class notes, right? So that's not important. Important is I want you to appreciate and enjoy the concept. But of course, if you feel that I learn better by writing, it's okay to do that. So again, this is the stock prices of A. Now look at how B behaves. Okay, so this is maybe the behavior of B. What do you see happening here? What do you see happening here? What's happening here is it looks like there is some sort of a inverse relationship between A and B. It looks like whenever A goes up, the B goes down, right? And what that is going to do is the average value of your portfolio, the average value of your portfolio might remain, the value of your portfolio might be a little bit like this, right? So this is the green line is your portfolio. Observe the value of portfolio is not fluctuating, but the value of individual assets is fluctuating quite a bit, correct? So what it teaches us that, and individually, maybe A is a volatile asset, maybe B is also a volatile asset, maybe they're very risky, but when I combine them together, not necessary that my portfolio is going to be risky. Okay, so how do I know whether the stock profile goes together, like whether they kind of increase together and decrease together, or whether they have an opposite relationship with each other? So we generally use a statistical number called correlation coefficient. Okay, so this number gives us an idea of how the stock price behaves together. Again, I don't want to get too much into basic statistics today, but very broadly, the way you want to think of this number is generally between a range of -1 to +1. Okay, so when I say correlation between stock A and B is, let's say, +1, what does it mean? +1 means they're always together. They're like, the two stocks are like, recently started dating type of couples, you're always together. And a -1 would be, people who've been married for 15, 20, 30 years, they're always, always challenging each other. So when one goes up, the other goes down, right? That's how you want to think of it. So maybe if you have, and maybe if you have stocks in your portfolio which exhibit such extreme -1 correlation, what it would mean is, it would mean that the returns are kind of behaving in opposite way. If one goes up, the other goes down. It's going to keep the volatility of your total portfolio in a controlled fashion. Okay, so that's the concept of correlation coefficient. So let me quickly give you a recap of, we've done 3 fundamental basics so far. First, how do you calculate return of the portfolio? You just do a weighted average, straightforward, simple, easy. How do you calculate risk of the portfolio? We calculate a number called standard deviation. We denote it with a letter called sigma. I would also be calling it as volatility. It's simply the fluctuation captured into a statistical number. How do you establish relationship between 2 variables, 2 assets? We calculate a correlation coefficient. There's a formula for doing it. That's not in today's session. But a correlation coefficient generally is between -1 and +1. +1 means perfect positive, always going together. -1 is perfect negative in the opposite direction all the time. Now, step 4 of our building block, which is kind of critical, and this is where we'll have to do a little bit of mathematics as well. So step 4 is, in the section 1, we learned how to calculate the expected return of the portfolio. Now we want to learn to calculate the risk of the portfolio. Okay, how do you calculate risk of the portfolio? And risk in today's session is synonymous with what? Risk is synonymous with standard deviation. Risk is synonymous with standard deviation. Okay, so how do you calculate the sigma of the portfolio? So again, let's go back to the same two stocks, HDFC Bank and Asian Paints. Okay, HDFC Bank and Asian Paints. Now let's bring in their individual risk or standard deviations calculated through statistical tool. Today I'll be showing you in Excel how to do it. And if you go through FinTree's level 0 course, you'll also understand formulas and everything around it. And if there's anyone who studied basic cons, I think for you, this number already makes sense. So let's say the standard deviation of HDFC Bank is maybe 5%. Okay, 5%, and standard deviation of Asian Paints is let's say 7, or let's spike up a little bit, let's say 8%. What are the weights? How much money are we going to put in each of the category? So we're going to put in 60% here. We're going to put in 40% here. How would you calculate? We'll need one more variable. What is the correlation coefficient of these two stocks? That means, are these stocks kind of moving together or they're moving in the opposite direction? Okay, what is the correlation coefficient? So I'm going to throw in a number. I don't know what that number is. I'm going to just say, let's say 0.7. Okay. So then how do you calculate the standard deviation of the portfolio? That means how risky the portfolio is. Okay, so how do you calculate standard deviation of the portfolio? You have to make use of this particular formula. This formula comes through matrix algebra. So we actually have to multiply the three matrices, but you don't need to get into, I'm sure many of us are a little rusty with, it's been a while we've studied matrices in a way. So we'll just look at the formula. The formula is weight of asset 1, whatever that asset is, HDFC maybe, multiplied with standard deviation of that asset 1 squared plus weight of asset 2, standard deviation of asset 2 squared. I'm intentionally doing it slow. I want to give you some time to sink in the formula. Okay, multiplied with 2 into weight 1 into weight 2 into standard deviation 1, standard deviation 2. I know it kind of looks crazy now, especially on day 1 of your finance classes. For some of you, it's a little overwhelming, but I'll simplify this. This formula actually looks a little bit like a plus b square. Okay, I'll tell you, and it has a very solid connection to that, into correlation coefficient. So weight 1 sigma 1 square, weight 2 sigma 2 square, 2 weight 1 weight 2 sigma 1 sigma 2 into correlation coefficient. The whole thing goes under root. Okay, this is what we're going to do. Now, I know this is going to look overwhelming, but we'll practice a few questions. We'll try to build muscle memory for you. We'll take you to a level where all of you feel comfortable with this. Okay, so I want each one of you to do this with me. Each one of you to do this with me on your Texas calculators, step by step. I'm going to use the Texas calculator app that I have on my mobile phone, and I want you to use the Texas calculator, and let's do it together. First, weight 1, that's 60%. 60%, by the way, is nothing but 0.6, right? So everyone press 0.6 on your calculator, 0.6. Okay, then multiplied with 0.05. So multiplied with 0.05. 5% is 0.05. And then you should be able to see a X square button on the calculator. Press that and tell me, what are you getting? What are you getting? I'm getting 0.0009. Some of you might see 0.001. That's because of the rounding off on the calculator. That's okay. Now we want to store this number. The Texas calculator has this amazing function where it lets you store. So we're going to store this in the first memory slot by pressing STO button and then pressing 1. You would find a STO button in the first column of the calculator. So press STO, press 1, it gets stored in the memory slot. Now we're going to repeat the drill with the second calculation. I hope all of you are with me on this. So now press 0.4 on your calculator. Multiply that with 0.08. 0.4 multiplied with 0.08. X square STO2. X square STO2. What are you getting? What are you getting? You're getting 0.00001024, right? So we'll put that in the second memory slot, please. STO2. STO2. And let's do the last term here. So 2 into 0.6 into 0.4 into 0.05 into 0.08 into 0.7. Just multiply everything that you see on the screen. 2 into 0.6 into 0.4 into 0.05 into 0.08 into 0.7 equal to, what are you getting? I'm getting 0.001344, right? Put that in the third memory slot, STO3. And now just add up the three. RCL1 plus RCL2 plus RCL3 equal to, so when you take the total, you would get 0.003, but please don't forget that there's an under root term there. So hit the under root button. There's a root X button on the calculator. So press that, please, and tell me what are you getting now. You would get 0.0571 something, something, something. So which is nothing but 5.71%. 5.71%. That is the standard deviation of the portfolio, or that is, on an average, the risk of the portfolio. Okay, so that's the sigma of the portfolio. Now, I know it sounds overwhelming when you do it for the first time, but when you practice 2 or 3 questions, your fingers will eventually know how to do it. We'll try and build muscle memory here. We will always store the equation this way: STO1, STO2, STO3. You practice a few times, you get okay with it. So let's do one more trial run. Okay, so let's have A and B. Let's keep sigmas of 8 and 12. Let's keep weights of 30% and 70%. And let's keep a correlation of a very low value of 0.2. Okay, I want you to make an attempt. Use the same formula, see if you can handle the calculations. It's very satisfying, by the way. Once you get, start getting these answers right, you kind of feel good about yourself and also feel happy that, you paid so much of money for buying this calculator. You feel like kahi to kaam mein aa raha hai, putting it to use somewhere. Okay, Prahlad on the YouTube chat box says, just dropped in here to say I passed May CFA level 1 exam with 90th percentile. Utkarsh Bhaiya, those crash course for level 1 is top notch. Thank you very much. Good luck all. You got this. Okay, congratulations, Prahlad. We have very happy. 90th percentile is not easy. And good luck for your level 2 as well. I've started receiving a lot of answers on the chat box. 9.18, 12.55, 8.96. Come on, guys, just repeat the drill, right? The same set of calculation. Okay, so I'm getting a lot of 9.18s. Rajiv has got the same answer. Rahul, Srihari, Tanmay, same. I think all of you are getting 9.18. Let's do it together. Especially those of you who are struggling, you can do this with me. But at this time, I'll do a little faster, okay? 0.3 into 0.08 x square STO1. 0.7 into 0.12 x square STO2. 2 into 0.3 into 0.7 into 0.08 into 0.12 into 0.2 equal to STO3. RCL1 plus RCL2 plus RCL3 equal to under root. I'm getting 0.09186, which is 9.186 percentage. Okay, those of you who are struggling, I'm going to repeat the keys one more time, just so that all of us are on the same page. And those of you who got the answer right, do it with me one more time, right? Any practice is good practice. You probably will have to do it on the exam. So let's do it together, everyone. 0.3 into 0.08 equal to x square STO1. 0.7 into 0.12 equal to x square STO2. 2 into 0.3 into 0.7 into 0.08 into 0.12 into 0.2 equal to STO3. RCL1 plus RCL2 plus RCL3 equal to under root 9.186 percentage. Okay, today's command word, by the way, I forgot to give you a command word. We have this command word, code word, or this type of thing. I don't know how it started. We just started. So we don't say yes in the class. If I ask you if you've understood, you throw the command word at me. So today's command word could be, what command word do you want to keep? Let's go with the I was thinking we'll since this is the first class for many of the people in the class, we'll go with our signature one, right? The one that's most popular. Yeah, I pass. So now if I ask you something you want to answer, if I ask you something you want to say yes, all that you need to say is I pass. Okay, and the more you say it, the more probability of that happening improves. So here's the question: have you understood this? Good to know that. Oh, Neeraj, that's a great news. I think we have a gold in this Olympic for Neeraj Chopra. That's a great news. Couldn't have been at a better time. Nice. Okay. I would like to continue with the flow of the session. So up to this, I'm hoping that you guys are reasonably okay. You might not have like 100% hang on it, but you're reasonably okay. I'll take about 3 or 4 questions before I take you to the next section, which is going to be completely on Microsoft Excel. So we build a decent background. Now we go to Excel and we start, putting it there. So those of you who would like to ask questions, queries, whatever on your mind, feel free to ask. Know that the session is being recorded and streamed live on YouTube. Like just a word of caution. All right, some people immediately put their hands down. All right, we'll start with you, Amarpreet.
Utkarsh,
Hello.
So Utkarsh, wanted to ask you, don't want to memorize this formula. So how to, intuitively remember this? If you could just simplify it. First is that. Second is, if I want to calculate a coefficient of correlation or return risk parameter for my portfolio, how to do it? And these, figures will be there somewhere where I can find out.
Hmm. So today, got it, Amanpreet. So let me answer the second question first. Today, I'll be showing you how to do this on live data. So we basically take an Excel file and do it from scratch, download data from internet and try and do it. So you'd get some idea about how you do it on your own portfolio. Of course, I'll be doing it with 2 assets, but the logic could be applied to multiple assets also. Um, your question was, is there an intuitive way to remember this formula? So this formula actually is coming through multiplication of 3 matrices, right? So I intentionally avoided that variance covariance matrix because I thought it's a beginner class, so we'll keep it slow. But an intuitive framework for you to remember the formula could be this. Remember the a plus b square we used to do, right? And a square b a plus b the whole square was, oh, by the way, there's a very bad, should I say it, Modi joke on it. And every time I see, I don't know how many of you have heard of it. Have you heard the Modi joke on a plus b the whole square? Like 2ab kahan se aaya? I feel like like you shouldn't have dwelled into it. Anyways, yeah. So a square plus b square plus 2ab, right? Don't do it now. You can go and look up the joke later on. Okay, now please focus. So a square plus b square plus 2ab, and like, okay, you know what I so like the Canadian Prime Minister, he would talk on metaphysics and stuff like that, and then we talk about a plus b square. Like I was honestly, when I heard that, I was a little kind of disappointed. But anyways, so a square b square 2ab. Now what's a square b square 2ab? Here a is your weight 1 sigma 1, right? So if you look at this term, this is weight 1 sigma 1 squared. If you look at this term, we have a weight 2 sigma 2 square, and this term is 2 weight 1 sigma 1 weight 2 sigma 2. There is one extra, kahan se aaya? There is one extra bonus element here, that's r. Okay, so there is an r kind of attaching to that a square plus b square. And again, in tomorrow's session, I would be building an intuitive framework on how this formula actually can be looked at a square and b square in certain situations. Okay, so that's the intuitive framework of memorizing the formula. The otherwise a precise formula which is coming from matrices is essentially the weight matrix multiplied with the variance covariance metric with the inverse of the variance covariance matrix, inverse of the weight matrix. So this is the true formula. On this, I have a video on YouTube. Okay, so if you just search for multiple asset efficient frontier or variance covariance metric, you would find I have done all the Excel calculations there also. But for all practical purpose, this is your memory trick. This is how you're going to remember it. How I would help you remember the formula is by kind of helping you build some sort of a muscle memory around it. So we'll practice this a few times so that you would end up remembering it. Okay, Aneet.
Yeah, hi, sir.
Hi.
So if in my portfolio it's highly, I'm having negative correlated assets. So can I say that my portfolio is not performing well?
Not necessary. Okay, not necessary. It is really a function of the level of risk that you intend to keep in your portfolio. In general, if you have negatively correlated assets within the portfolio, you will have some benefits of risk reduction. Okay. So that means the overall risk in general, lower the correlation, higher is the benefit of risk reduction. The risk of the portfolio comes down. But at the same time, it also means that maybe the upside will also be compromised, right? So the challenge for us today in this session as finance professionals is that when clients will approach us, we want to give them a good return. At the same time, we want to reduce the risk. So we want to bring in a beautiful balance of that risk return, combination, and that's where the optimization will come in play now in the second section.
Okay.
Did I answer your question?
No, sir. Still, yeah.
So if the assets in your portfolio are negatively correlated, what you can conclusively say about your portfolio is that the risk will be reduced. Let me give you a practical example. For those of you who've been working in the markets or who have basic idea, I'll tell you what I would most probably start doing starting from next week. Okay, so many of you know that I'm kind of a long equity investor, and generally, like, my allocation is mostly equities because I believe in them and I believe in their power. But now we've reached to a level where, and if there's noise coming in from your end, so I'm just putting it on mute. So, but now we've reached to a level where, the valuation in the markets is making me a little bit of uncomfortable, right? So we don't know whether the markets will correct or not, but looking at some of the valuation, I feel like, it's not justified. So what I want to do is I want to protect my portfolio and reduce a little bit of risk. So what I might start doing next week onwards, and, I'm not sure, but I'm currently kind of devising a strategy, is to basically start adding some out of the money put options to my portfolio. Okay. And I'll probably start by hedging first 20% of the portfolio, and then maybe eventually hedge 40 or 50%, depending on how I perceive the market. Now, what does it mean, and, what it means from a portfolio perspective? So when you have long equity and when you have long put, these are more or less negatively correlated assets. So their correlation could be, as low as maybe a negative 0.8. What does it mean? It means when equity goes up, the put options will go down. But when equity goes down, the put option will go up. So those of you who don't know put option, don't worry. Just know that they are opposite of, shares. So when shares go up, put options go down. What will that do is it will reduce the overall volatility of my portfolio, right? And why do I need that protection today? Because, I fear that in the last couple of years, there have been a lot of gains made on the long equity portfolio. Now my job as an, investment manager or money manager for myself is that I want to protect some of these gains that I've made in the portfolio. So what if there's a market correction, and what if we have some sort of an inverted V type of structure where we have a massive drawdown? So in this situation, I will lose all the gains that I've made in the portfolio. I want to protect them. How can I protect them? I can simply buy put options. So even if, stock market falls, the value of the put option at that time will go up, right? So the overall value of the portfolio might remain intact. So negative correlation of the assets within the portfolio will provide you benefits of diversification. The risk of the portfolio will go down. Does it answer your query now? Okay, you're on mute, but I hope it did. Let's take one more question. Surbhi. If anyone from Bangalore wants to raise a query, I think talk to Vaibhav. He'll help you with the mic. You can do that as well. Surbhi, you're good to go. Just unmute yourself. Okay.
Hi, am I audible?
Yes, you are.
Yeah, actually, I had some doubts and calculations, but I just did it and I'm good to go.
Okay, so you're able to do it now?
Yes, absolutely.
Okay, good. Srihari.
Hello everyone. Can you hear me, sir?
Yes, you're audible.
Sir, actually, I have a query regarding this. What you made the hedging kind of portfolio. It's like my question is, why would anyone would like to have this kind of portfolio where if on the one stock is going up and the other stock is hedging it, so there's no profit and loss, there's no return we are recovering. So why would anyone would like to have such kind of portfolio?
So it is that's actually a good question, because if you think of it that when one goes up, the other the other goes down, then obviously the question is, why would you make returns, right? So the answer to that is that especially like the strategy that I built, right, OTM puts. Now the way this strategy will work is uh, imagine you have a 100 rupee portfolio here. Okay, so 100 rupee cash portfolio. And can you hear me? I think the Bangalore video just dropped out. Guys, can you confirm if I'm audible?
Yes, sir.
Okay, all right. So you have a 100 rupee portfolio, and what you do is you buy, let's say, 5 rupees worth of put options on top of it. Okay. Now, the way I'm this is coming at the cost of oversimplification, but you'd get an idea of where I'm going with this. So let's say, my portfolio, 100 rupee portfolio goes up to maybe 120. Okay. This 5 rupee put option will become worth 0. So on a totality basis, I invested 105 and now I have 120 with me. Correct? So that's one scenario where put options don't help me, but the portfolio helps me. So this is scenario 1. Scenario 2 could be that 100 rupee asset kind of goes down to maybe 70, but then put option value goes up and maybe they reach at I don't know, let's say 25, 30. Okay, so let's say 25. So the value of the portfolio is 95. Now this is where the diversification or that negative correlation will really come in handy. And the reason why it will come in handy is because if you had not purchased the put option, the value of your portfolio would have been just 70, right? There would have been a drop of 30. But because the value of these put options went up, it protected a little bit of your downside. This is, by the way, called protective put strategy for those of you, who do not know this. And scenario 3 could be that 100 remains, at 100. So if 100 remains at 100, there's a good probability that 5 rupees will become 0. So my portfolio value will be, 100, not 105. So I lose 5, but I will be okay to give up that 5 because it's, it's going to provide me insurance in this particular instance. Okay, that's about strategy. If you're keen on knowing more about this, just look up protective put. There's plenty of stuff on the internet. You should be able to find some good content on it. I also have a few videos on this.
Okay, sir, got it. Yeah. So, yeah.
Okay, all right. I hope you guys are enjoying the session. Here's what I'm going to do. I think our building block is over. Now is the time to kind of get our hands dirty and start doing stuff on Excel. But what I want to do is give you a nice break so that when you come back after the break, you're kind of learning with all your attention. So we're going to have a 20 minutes break. Okay, the way it's going to work is I'm going to put on a timer on my screen, and same screen will also be kind of streamed on YouTube, and then you guys can come back in 20 minutes. After the break, we are going to start downloading some data from the internet of few stocks, and we are going to start doing some very interesting calculations. Okay, it's going to be a lot of fun. You do not want to miss it. So please come back in 20 minutes time. And people in Sendur, people in Bangalore, I'm jealous of you because you would get to drink that really nice Sendur cup of chai. Okay, so I'll see you back in 20. Let me put on a timer here too. Okay, all right. It seems people are still coming back. Okay. So while people are coming back, do you want to listen to an interesting story? Okay. All right. So our story starts. In roughly in year 1550. So that's a pretty long time back. But the story is kind of relevant to what's happening today. So you'd be able to relate. You'd be able to relate to it. So here's what happens now. Somewhere around 1550, I mean, there's a little bit of documentary evidence to the story. Like some pieces are fairly known, some pieces are, the historians have kind of figured that out. So yeah, we'll invest 5 minutes in the story. People should come back by then. Then we get started with the portfolio management stuff. Okay. So 1550, there's a emperor or king of or some royal family of the Ottoman Empire, and this family sends a particular type of flower to a royal family, to one of the Dutch royal families. Okay, the today's Netherlands. Now, this flower did not exist in Europe at that time. It was some sort of a new flower, and what the royal family in the royal Dutch family does is it basically plants that particular flower in front of their house, and they kind of try to make a nice garden out of it. Okay, now few years pass. We're talking about 1950s and 1550, 60, 70, 80, 90. Now they have a beautiful garden, of these very pretty flowers in front of their house. And then what happens is that the other royal families and the other traders and merchants, who are also wealthy, they feel like, why aren't we having these flowers in front of our house, right? Why aren't we having this flower? Because now by this time, having these flowers, having these plants or these flowers in front of your house is some sort of a status symbol, right? So today that's think of it as today's equivalent of what are today's status symbols. Maybe having an expensive car or an expensive house or maybe an expensive watch or whatever it could be. Tesla, fair enough. The Tesla is much more than that, but yeah, whatever. Whatever. Okay. So everyone wants to have, everyone wants to have this flower with them. So how do you plant this flower? You need to get a bulb, right? You need to get the bulb of that flower so that you eventually be able to plant the flower out of it. So what happens is because there is suddenly that surge in demand for these particular flowers, the prices of these flower bulbs start increasing. So let's say the price maybe was one guilder earlier, then it becomes 2 guilder. So that's like almost double, right? And then 3 guilders, and then 4 guilders. And by 1630s, the prices have increased quite a bit. So thank you. I think someone is helping me get the visuals on the screen. I think it's Dashrath from my team. Thank you, Dashrath. So a new bunch of people, they get excited in these flowers or these bulbs. This is how they look, by the way. If you can see my screen now, Dashrath, if you can just zoom on one of the pictures. So they get interested not because they care about the flowers or these bulbs, but they care about the fact that the prices of these bulbs, are always increasing, right? So they say, you know what, we don't care. Flower, okay, fine, nice, but we don't care. We want to make money out of it. So what we're going to do is we're going to buy these bulbs. Okay, yeah, they look like onions. You're right. We're going to buy these bulbs. And we're going to wait for the prices to double, like how they've been doubling in the past, and then we're going to sell them. So buy it at 4 guilders, sell it at maybe 8 guilders, 9 guilders, right? And then whole 1630s up to 1636, the prices are increasing. And increasing how? From 1 to 4 to 10 to 30 to 40 to 50 to 100. It is just growing at crazy level. And then, these bunch of traders, the only thing that they're doing is they want to buy, they want to sell them. Also around the same time, and this is very interesting, there was one particular farmer / trader who had these bulbs, and these flowers were attacked by a particular type of virus. Okay, there was a particular type of virus which we know today, which they did not know at that time. So it was attacked by a virus. And what that virus did is it basically broke down the color of the flower petals. So it basically created 2 shades or 3 shades of those flowers. Now, what this trader did is, when the flowers were seen and, the other people came and they said, this looks different. He basically, here we have them on the screen. So he basically, told people this is a different variety of flowers. Okay. And then they started giving them exotic names. For example, some of these flowers were called the General of General or the Admiral, or they were giving fancy names, and the prices started increasing even more. Okay, and everyone now wants to get into the action. Why? Because they love the flowers? No, because they feel that if I buy these flowers or if I buy these bulbs of these flowers, then very soon the price will double, and then someone will buy it from me. And people would have also thought that I'm buying these bulbs for, let's say, 100 guilders. I'm stupid, I'm a fool to buy it so expensive. At the end of the day, it's just a flower. What can I do with it, right? I can't even eat it. So I'm buying it at such an expensive price. I'm a fool to do it, but it's okay. Very soon I'll find a person fooler than me who'd buy it from me at double the price, right? So I'm a fool to buy it at 100. Very soon I'll find a greater fool who'd buy it at 200. So this is called the greater fool theory, right? That I'm going to find some other fool to buy it from me at higher prices, and the prices are increasing now. Okay, and there is some financial innovation happens around it to a level where there's an estimate that price of some of these breed or varieties of these flowers, it reached to a level of about 4,000 guilders, from the level of 1 to 4,000. Now, just to set some sort of a context, during those days, skilled craftsmen, skilled people, their annual income used to be roughly about 300 to 400 guilders. So imagine you're earning 300 guilders a year, and you're spending 4,000 guilders to buy just a flower or a flower plant in a way, right? But people still did that because they thought, I'll be able to sell them at a higher price. It went to such crazy levels that price of one bulb or the price of one flower was equal to price of a massive villa, in Netherlands at that time. Okay, so the prices kept on increasing. And then came 1937, if I'm not mistaken with my dates, I think in the month of February. Suddenly, people realize that why are we buying these flowers at such an expensive price? There's no underlying value to it, and suddenly the demand for these flowers reduced, and the prices crashed to near zero levels. Okay, and the flowers that I'm talking about, most of you already guessed. You probably saw them in the images. But the flowers we're talking about are tulips, and this is this phenomena, or this is kind of the first recorded asset price bubble in the history of mankind. Okay, so probably what we are seeing today in the market, what we're seeing today in the market with some of the assets, because there's so much of money floating, and we are buying assets just because we're thinking we'll find a greater fool to buy it at even expensive price. At some stage, the bubble will burst. In fact, there's a very famous quote which says that every bubble is accompanied by a pin, sharp pin, and they're just waiting to meet each other, right? So at some price, a bubble will burst, and probably the prices will correct. And this is where the word tulip mania comes from. Okay, I'm not sure how many of you have heard of tulip mania. But tulip mania is a term used to kind of refer to asset bubbles. Now, have we experienced asset bubbles in the recent history? Yes. I think one of the massive bubble that we experienced was in 2007, right, with the real estate prices. We also experienced bubble in 2001, or time leading up to 2001, especially up to 1999 with the technology stocks in the US, right, where they traded at crazy valuation, and bubble kind of burst in 2000, 2001. Some would say maybe Bitcoin was in bubble. I don't know. Like, I'm not an expert, so I try not to talk about it. But yeah, maybe Bitcoin, maybe they behaved in a particular fashion where, some people thought that it was a tulip mania type of instance. And maybe, just maybe, August 2021, we see crazy amount of euphoria and enthusiasm in the market, and some of the assets are trading at crazy valuations, like unbelievably expensive valuation. Maybe we are going to that territory, right? We don't know if we are already there. Maybe we are not. Maybe we'll go there, but it definitely looks like we are slowly inching towards the bubble category. So remember the word tulip mania. Okay. All right. So with this now, let's get started. Those of you sitting at home or watching this session on YouTube or Zoom or whichever place, if you have a computer handy with you, and if you want to do this along with me, that's okay. I think a better option would be to just see how I'm doing it, go through the entire process by just observing and not doing it. Because what will happen is, if you try to do this along with me, maybe you'll not be able to catch up the speed and you'd miss some important points. Okay, so a good idea would be just to watch, go through the entire process, and then try and do it yourself. And if you get stuck, anyways, the video sits on YouTube, right? So you can always come back and do it the way you like yourself. So with this, let us get started. This is going to be a lot of fun. I really enjoy doing this part. So to start with our calculation, the first thing that we'll have to do is we'll have to choose two assets. Okay, and we will have to download their historical data. We can choose any assets. It does not have to be Indian stocks, but it could be easy if you do Indian, but anything is okay, as long as data is available. So what I'm going to do is I'm going to go to Yahoo Finance. And I'm going to search for historical data of the same two stocks we spoke about earlier, HDFC Bank, and let's see what we get. Okay, so we have HDFC Bank data available. Let's see if I'm allowed to download historical data easily. So we'll try and use consistent data set. We'll choose a five-year period. And with what frequency, we'll use a monthly frequency. Okay, so I don't want daily data because then that would be too much of data to work with. So we'll have a monthly frequency. And apply, and let's see if we can download this. All right, so the first file is ready for us. We have HDFC Bank stock prices. Now, I don't need all this data point. Can you see all the columns that I have? Open, high, low, close, adjusted close, volume. I think I'm just going to stick to the adjusted close prices. So I'm going to delete all of these extra data that we have. Neither do we need volume. We just need dates. We just need prices. I'm going to come to the date column and do a little bit of formatting. The shortcut is Control, Shift, and hash. So it just kind of formats the data to a more easier readable date style. So I have the stock price, of HDFC Bank from 1st of September 2016 till 6th of August 2021. And what are the stock prices? It used to be in the range of 620-ish, fell down to 580, 875, and 1100, 1200, 900, 1500, 1400, and so on and so forth. Okay, so I hope all of you are with me on this. So HDFC is kind of done for us, HDFC Bank. Okay, so that's a starting point for us. Now, once we've taken HDFC Bank, then we go and we start looking for Asian Paints. Okay, that's the second stock we've chosen, right? A really good Indian paints company. You should see, you should look at the history of the company and how these guys have managed. Like this, almost every aspect of their business that I love, except the valuation. But phenomenal business. It has made a lot of money for people. So we'll take the historical prices. We'll take monthly data, and let's hit apply, and let's download. Now, of course, I'm not considering dividend or any of those kind of things in my analysis, but you can always fine tune, right, based on the requirement. But today's session is not about going too granular, but basically building a perspective on how it can be done. All those small tweaks and adjustments can always be done. So we have the same set of data for Asian Paints here. I'm changing the formatting of the date. I'm hitting a Control, Shift, and hash button, so it kind of looks a little better. And I'm going to get rid of these columns. So we don't need this. We don't need the volume. What we need is just the dates and the stock price. And if you can see here, we have the stock used to be about 1100 type of range in 2016 September. And then it has moved from 1100 to 1300 to 15, 1700. It's about 3,000, roughly 3,000 rupees now. So that's about 3x, 3x in for 5 years time. Okay, which is a really, really good return no matter where you are in the world. Now, because I need these data comparable into one single file. So what I'm going to do is just copy paste this column. The dates are comparable, 1st September to 6th of August. I'm going to go to the previous Excel file and plot the data here. Okay. So now what we have is one single file where we have both of these data points available. And I think I'll have to create a new Excel file with a different extension. So just give me a minute. File. Okay, and I'm just copy pasting the whole data here. I'm going to save this file for you. This file should be available for download. If you're attending this session on Zoom, it should be available in your chat box towards the end of the session. If you're attending this on YouTube, it should be uploaded in the link in the description. Okay, so this is your efficient frontier file. Let me just save it. Okay. So step number 1 of our exercise is done. We have historical data. Now, typically when you're building efficient frontier, like here, I'm going to do it with 2 stocks, but can I use the same logic and build it for, okay, some people want the file now. I don't mind sharing it. I'm sharing it on the Zoom chat box. Okay, so that's perfectly fine if you want to work with this. Here we go. It should be available on Zoom chat box for those of you who want to kind of do it along with me. All right. So I was saying the first step is getting the stock prices. Right now I'm doing it for 2 stocks. Can I do it for 5 stocks? Yes. Can I do it for 10 stocks? Yes. Can I do it for 50 stocks? Yes. It's just that the higher the number of stocks, the more complex the calculations are going to be. And we will eventually have to build a, variance covariance matrix and do a little bit of matrices there. Not received. Okay, I think I shared it to just the panelists. Okay, sharing it again. Now it should be available. Yeah, so coming back. Now, can I extrapolate the same logic to multiple stocks? Yes. If anyone is interested in doing it, I do have a video on YouTube that basically explains how to do the same set of calculation using matrix algebra. You can look that up. It should be with some title. You should be able to find it. Okay. So anyways, so now we have HDFC, we have Asian Paints. What do we need next? Next that we need to do is we need to calculate the percentage returns. Okay. So percentage returns on HDFC month-on-month basis. Okay. And percentage returns on Asian Paints. Asian Paints. Percentage return on HDFC, percentage return on Asian Paints. Sorry, the file is still not received, or have you guys received the file? Received? Okay. Yeah, those of you on Zoom chat box who are struggling to get the file, that's because your Zoom app is not updated. Okay, so apparently there's this thing with Zoom that you have to have the latest version of the app to receive the files on the chat box. But it's fine. We'll also be uploading this on the FinTree LMS, so you would receive it eventually. Okay, so now please focus. I would recommend don't do it along with me because maybe you'd fall behind and then you'd miss some critical points. So just observe how it is being done, and then maybe you can try it yourself. Okay. So how do you calculate returns? Let's say a simple example. 100 rupee stock becomes 105. So what is the return we want? 5%, correct? So one very easy way to do it is, what I can do is I can simply say in Excel, let me zoom my formula for you. Okay, so let me zoom this a little bit. So I can simply say the closing value of the asset divided by the opening value of the asset minus 1. Okay, so when I do 10, I know at the risk of stating obvious, but just for those people who are probably doing it for the first time. So when I do closing value divided by opening value minus 1, I would get that 5%. 0.05 is nothing but 5% here. Okay, so I'm going to follow the same logic with these calculations. So observe how. I want to calculate returns on HDFC Bank. So look at my formula. Is equal to the closing value on 1st of October. The stock price was at 613 divided by the opening value. The stock price was at 620 minus 1. Okay, and obviously it's going to be a negative return. So what return are we looking at? We're looking at a negative 1% return. Okay. Now this is a discrete return calculation, and for efficient frontier purposes, this is a fair set of calculations to do. Now, one good thing with Excel is that once I've written one formula, I can simply extrapolate that to whatever place I like. So I'm going to extrapolate the formula for the entire range. Also, the last data points is not one complete month, right? Look at this, 1st of August and 6th of August. So I'm going to get rid of the row number 62 here because then that would create inconsistency in the data. So here we delete the row number 62 here, and we have data till 1st of August itself. Is everyone with me up to this point? Look at my formulas, closing by opening -1. All of us are together. Is it making sense? Are you understanding what we're doing? Easy, right? Nothing complicated so far. Yeah. Now, when you do it for the first time, for some of you, the number will look like this. Okay, it will look like this, and you would wonder what's happening. So basically, it's just a formatting question in Excel. So how do you change number to make it look like percentage? What you need to do is select the entire data that you want to convert to percentage, and you want to press Control Shift and percentage button. Okay, Control Shift and percentage button, so that it converts that to percentage. And how do you extrapolate? I just did how do you extrapolate the formula? Just do Control C, Control V. It's not an Excel class, but just, in case if anyone is curious in doing this on Excel, you'd know how to do it. Okay. So look at the formula, same, right? Closing divided by opening -1. So all that we've calculated is that in the last 5 years, what is the return that we've earned on a month-on-month basis? What is the return that we've earned on a month-on-month basis for these approximately 60 months? So we should have about 59 data points. Yeah, here, can you see? I have 59 data points. That's because, if I use 60 months, I will be able to calculate returns for 59 periods. Okay. So we have these data points. Now, what do we do with them? Now I know that if I'm an investor in HDFC Bank, okay, first, if I had bought the stock on 1st of September, by 1st of October, my return would have been -1. But in the next 1 month, I earned -5. Then month after that, I earned +1. Then I earned a really good 7%, 8%, so on and so forth. Now, what I want to know is, just a minute, okay? Okay. So what I want to know is, what is the average return that I have earned over these 59 months? Average means, okay, some month I'm earning more, some month I'm earning less. So what is an average return? Okay. So what I'm going to do is I'm going to calculate an average for these 59 values. Average is simply mean. Add the numbers, divide by number of observations. So for example, if I have to calculate an average of, let's say, 2 and 5, what would be an average of 2 and 5? Add the 2, divide by 2. So that should be 3.5, right? So this is the formula you use. You use a cool function in Excel called average. Okay. And it basically does the job for you. It will get you 3.5. So I'm going to do the same stuff. I'm going to use the average formula to get the mean of these. So E is equal to average. And then I'm going to select these 59 values here. Okay. So the average monthly return is coming out to be 1.76% for HDFC Bank, and it's coming out to be 1.89% for Asian Paints. Okay, can you see? I'm just using the same formula, average. So on an average, how much return do I expect to earn every month? 1.76. Does it mean every month I will earn 1.76? No, there will be months when I will probably earn more. There would be months when I would probably earn less. But on an average, we've taken a large sample. On an average, it looks like it would be 1.76 and 1.89. Now, these are the expected return, and obviously, they look really nice. The next question you want to ask yourself is, what is the level of risk we have in each of the stock, right? Are they like very volatile stock, or are they like stable stocks? So if I just put them on a simple line, just to build some sort of a visualization on them. Okay, so let's take this and let's take this here. And if I put them on a line, let's see how it looks. So we'll try and put this data onto some sort of a line. Okay, here we go. And it looks like a little cluttered, but that should give us some sort of a idea about their volatility. The blue one is HDFC, and the orange one is Asian Paints. What do you think? Which one looks a little more volatile to you here? HDFC maybe, right? Except like we have these extreme negative outliers where it looks like there was a month when we were more than negative 20%. Okay, so of course the data needs to be investigated, but it looks like there was a negative event. Must have been the time when their top management was, quitting, and there was some rumors happening, which was actually a good time to buy stock way back. But we'll have to run the numbers and calculate the standard deviation to figure out which one is more volatile. So I'm going to delete this graph. It's not of much use here. Let's calculate the standard deviation. So standard deviation, here's how I'm going to do it. I'm going to use a cool Excel function called STDEVS. Okay, so this is a formula that calculates the standard deviation of the dataset directly. Can your Texas calculators do it? Yes. Okay, so there is a data function and stat function in Texas calculator. Your calculator can also do it, but it will take a lot of time and to explain that now. So maybe you can watch some of my basic stats videos. But right now I'm just going to make use of this and calculate the standard deviation. Yes, I'm using standard deviation of the sample. And wow, we're getting a pretty large standard deviation for HDFC Bank of 7%. And we're getting a standard deviation fairly large for Asian Paints as well. Okay, so the standard deviation for Asian Paints is roughly about 7%, and for HDFC Bank is 7.14. So what do we have now? We have the expected return and risk available in the portfolio. Okay, now is this the past return or future return? Is this the past return or future return? This is the past return. But when we build portfolio, do we build for the past or do we build for the future? When we are trying to take portfolio decision, are we doing it for the past or the future? We're doing it for the future, right? So quite possible that maybe in the past HDFC earned 1.76, but maybe it will earn a little less, right? So this is where a little bit of that, financial judgment comes in. This is where something called as financial modeling comes in. Okay, where you kind of try to make some high probability guesses about the returns. So not necessary that you always use the past data as it is, but you can take some hints from the past. You can say, okay, if this is what has happened in the past, maybe the same thing will happen in the future as well. Okay, so that could be one way of doing it. So that's my sheet one now. So here we'll say in the first part we just did the return calculations. All right. Now let's start building portfolio using these two stocks. So let's start building portfolio construction using these two stocks. Okay, so how I'm going to build the portfolio now. So these are my two stocks. I have HDFC Bank. I have HDFC Bank, and I have Asian Paints. I'm going to take expected monthly return. Okay, you could do this for annual basis also. Generally in practice, most of the time it's done on annual basis, but I don't have 10 years of data or 15 years of data available, so I'm doing it on monthly. It's fine, it doesn't make a big difference, at least for learning perspective. So expected monthly returns, and obviously a standard deviation, right? A standard deviation. So monthly returns, we'll just bring in these values. We will say it is 1.76 and 1.89, and standard deviation is 7.14 and 7%. I've just linked these numbers. Now, one more thing we will also need a correlation coefficient between the two. Remember, we discussed correlation coefficient. I told you that's a number between A positive infinity and negative infinity. That's what I told you. The range could be positive infinity, negative infinity. What do you think is the range? Yeah. All right, smart people. -1 and +1, right? -1 means -1 was what? A negative correlation, and a +1 would be a positive, like a perfect positive correlation, right? But we could be somewhere in between. Yeah. Okay. So let's do a correlation coefficient calculations there. Okay. So let's calculate a correlation between the two. Now, again, there's a formula for doing it. Some of my basic statistics videos, I've explained correlation in depth, but today is not the class for that. Today is the class to make use of it. Good news for us, Excel does all the math for us. So all that you need to do is make use of the formula called CORREL and open the brackets and select the two data set. So I'm going to select the first data set here, comma, select the second data set here. So select the second data set here. All right. So notice how I've written the formula. I've just, okay, my Excel is being a little slow today. I've just, selected this data point. I'm going to hit enter, and there you go. We have a positive correlation of 0.3380. Okay, a positive correlation of 0.3380. So that means it looks like both the stocks are moving in the in the same direction, right? Maybe there's some sort of a linear relationship there. Maybe they're related, but it is not a relationship of +1. It's not like it's always perfect. It's a relationship, positive, but not not always perfect. And we can kind of correlate that on some data points, right? Here we have negative, here we have positive. Correct? So there are some anomalies. Here we have a +10, here we have a -5. So therefore, the correlation is not close to 1, but it's still positive. So come back here. Let's bring in that correlation number from here. So this is my correlation coefficient. Now I'm going to keep on doing these calculations on monthly basis. I'm not going to convert them to annual. Okay, we'll keep it monthly. Now here's my most critical question to you. Let's say you have 100,000 Indian rupees. You have 1 lakh Indian rupees. Okay. You want to put some of your money into HDFC Bank. You want to put some of your money into Asian Paints. Tell me how much money you would put in each of this category. How much money do you want to put in HDFC Bank? How much money do you want to put into Asian Paints? How would you take that decision? Give me a percentage. Give me a percentage. Like, what do you think? How would you like to go about it? Give me a percentage. Come on, throw in your answers. Give me a percentage. Okay, a lot of people are saying 40-60. Some people are saying 60-40. Some people are saying 45-55. Some people are saying 70-30, 50-50, 40-60, 30-70, 35-65, 32.562. You must be a mathematician, sir, or a physicist, or you must be really high. How did you get that number? 32.5, 62.5. Okay, fair enough. 10 and 90. Vikram wants to go 10 and 90. Vikram is a pilot. He has a aircraft view on the two companies. Maybe he doesn't like HDFC Bank. 10 and 90. Fair enough. See, now this is a good question, right? Bob says 11 and 89. Bob is a doctor, right? Maybe he has that doctor's brain. Something is happening there. He doesn't like HDFC Bank, so he's going 11 and 89. The question that we want to ask is, when clients come to us with question like this, right? When clients come to us with questions like this, there should be some sort of a smart way of answering them, right? There should be some sort of a mathematically optimized way of answering them this question. And that's what we're going to do now. So what we're going to do is we're going to use an optimization engine. We're going to use an optimization algorithm. We're going to optimize the portfolio in such a way, okay, that the client will get the best type of return, but also reasonably lower type of risk. This is where that mathematics will come into play. So what Harry Markowitz did, and remember he did this in 1960s. Those days, we did not have computers what we have today, right? We're talking about 1960s. So a lot of this algorithm, must have been solved by hand or using primitive basic calculators. So what Harry Markowitz did, he said, okay, one very easy step number one to solve a question like this is to simply create a bunch of hypothetical portfolios. We're doing it on Excel file. Who's stopping us? We can create 500 portfolios. How do you create hypothetical portfolios? Just create imaginary weights. Okay, so I'm going to create imaginary weights here. So here I'm going to create a column which will say weight of HDFC Bank, and weight of Asian Paints. Okay. And I'm going to start with something random, like let's say minus 90%. Wow, minus 90%. Is that even possible? If I have 100 rupees, how can I invest minus 90%? And then what would be the weight of Asian Paints? It would be 190%. Observe the total of these two will always be 100%, right? The total of this and this sum will always be 100%. Can you see this? Now tell me, is it possible? Like, can we have a negative 90% weight? Yeah, in theory at least, right? In theory. And of course, in certain economies, yes. In the introduction of the session today, which was not on YouTube, but when we were conversing on the Zoom panel, there was one gentleman who said, I work in securities lending, right? When he was introducing himself. Now, all that he meant was that he basically lends stock for other people to sell. Okay, so in theory, it's possible that you can sell some stock, and that money that you get by selling the stock, you can put into something else. Okay, that's called short selling. It's called borrowed selling. It's doable. Again, not the topic for today. Maybe some other day in equity sessions, we'll discuss that in depth. All right, but just for the sake of argument, just assume that this is doable. So this is my one portfolio. Okay, so we'll give it some sort of a serial number. Okay, just to reference it. So this is the first portfolio. What could be a second portfolio? Let's keep an interval of 1%. So interval of 1% means I will do a positive 1 here. Okay, so this will become 190. This will be negative 89. This would be 189. Getting it? Now let's create roughly, I don't know, let's create about 300 portfolios out of it. We could create more, but we'll create roughly about 300 portfolios out of it. So let's drag it down. Okay, maybe a little bit more. So let's create roughly 300. In theory, we can create infinite portfolios, right? As many as we want. It's the Excel which has to run the maths. Why would we worry about it? And then I'm just going to keep that interval of 1% and extrapolate that for the whole range. Boom, there you go. All the 300 possible portfolio combinations are ready with us. Now, we start with negative on HDFC Bank, positive on Asian Paints. And as we scroll down, you would see that slowly the Asian Paints weight is reducing. Then we enter into a positive territory where we have, a positive 6 on HDFC and 94, right? This is more of a practical scenario, right? That's what we do in practice. We'll probably put in some money into one stock, some money into other stock. So this looks like a more practical region. And then, as we go downwards, slowly HDFC Bank is increasing the weights, and Asian Paints is decreasing. Then we reach to a level where not investing anything in Asian Paints at all. 100% into HDFC, 0 here. And then we enter into negative territory for the Asian Paints, like how we had negative for HDFC Bank. And in this fashion, we've created close to 300 hypothetical portfolios. Now that 1% gap that I kept, that's arbitrary. You could keep 0.5, you can keep 0.25. That's why we can create infinite portfolios out of it. Now, out of these portfolios, which one is smarter? So to decide that, we'll have to do something. You tell me. To figure out which one of these portfolios is smarter, how can we figure that out? To figure out which one of these portfolio is the smartest portfolio, how can we figure that out? Correct. We'll first say, okay, fine. These are the possible portfolios. We have learned how to calculate standard deviation of the portfolio. Can I calculate the risk of each of these portfolio? Is that doable? The risk of each of these portfolios? Yes. So what I'll do is I'll calculate a standard deviation of the portfolio. Okay. How would we calculate standard deviation? Using the fancy formula that we were learning before the break. Then, can I also calculate the returns of the portfolio? Is it possible to calculate the returns of the portfolio? How? How would I calculate returns of the portfolio? Correct. That before the break, we were learning how to calculate those weighted averages, right? How to calculate those weighted averages, weight into return plus weight into return, same stuff. So what I'm going to do is I'm going to basically write one formula for standard deviation calculation and just copy paste that for the entire data. One formula for returns, copy paste that for entire data, and that's it. Then we'll have risk and return of each of these 300 portfolios, and then maybe we'll be able to make a better selection, right? So let's do standard deviation. This formula takes a little bit of practice of writing. Okay, so I'm going to do it slowly so that you can observe how I did it. But of course, if you don't care about doing it on Excel, then for CFA and FRM exams, you already know how to handle this. Okay, but let's do it slowly. Let's try and have fun with it. So is equal to, let's try and remember what was the first term. Weight 1, standard deviation 1, the whole thing this multiplied squared, right? Weight 1, standard deviation 1 squared. So let's do it then. So bracket open, weight 1. So I'm taking HDFC as the first stock multiplied with the standard deviation of HDFC. Okay. Now what I'm going to do is I'm going to copy paste this formula downwards. And the problem is that if I just keep the formula like this, then what Excel will understand is Excel will understand that I have to go 2 cells on the left. So that's weight. And I have to go column on the left and 4 cells above to get that 7.14, right? But obviously, if I copy paste it downwards, it will change that 7.14. So what I need to do is something called as the freezing, right? We need to freeze. We want to freeze the cells so that that C3 remains constant. Now, if you're on a Microsoft machine, what you need to do is just hit a F4. Okay, I am currently on a MacBook, and I'm kind of reluctant to learn the shortcuts here. So I'm going to do the old school way, and I'm going to just manually go in and throw in $signs there. Okay, so this is called an absolute freeze. It means when I call some technical glitch. I think my internet connection tied up in interim. I hope I'm still audible, visible. Can you guys confirm on the chat box? Yeah, okay. All right then. So I was asking you that I've selected this, I've selected this 190. What do you think? Do you think I should freeze it, this 190? I should not, right? Because when I copy paste downwards, it should be able to select the appropriate weight. The weights are constantly changing. Standard deviation is not. Multiplied with standard deviation of Asian Paints 7%. What do you think? Should I freeze this? Yeah, and I should do an absolute freeze, right? Which I could also do a relative freeze here, but let's not get into that. Just let's throw in $sign before and after, and we're done. Raised to 2. So weight 1 sigma 1 square plus weight 2 sigma 2 square. Up to this, I hope everyone is comfortable with this. Let's do the last term now, right? So last term. So last term is going to be plus 2 into, come on, sing the song with me. 2 into weight 1 into weight 2. Should I freeze weights? No, because we want them to be changing, right? Into standard deviation 1 into standard deviation 2 into correlation coefficient, correct? So 2 into weight 1, weight 2, standard deviation 1, standard deviation 2 into correlation coefficient. Now tell me, what should I freeze in this last term? Like, do I need to freeze anything? Yes, obviously I have to freeze those standard deviations, right? Which are coming in cell C3 and D3. So C3 and D3, because when I copy paste, obviously I want, the Excel to pick up the same number of formulas, right? So I've frozen them. How about correlation? Do you think I need to freeze it? What do you think about correlation? You think I should freeze it? I should, right? Because when I copy paste again, we want it to pick up the same correlation number. So formula done. Am I missing on anything here? Is the formula done, or do I need to throw in something here? Correct. It's basically an under root, right? Weight 1 sigma 1 square, weight 2 sigma 2 square, weight 1, weight 2, 2 sigma 1 sigma 2 correlation, the whole thing under root. The whole thing under root. I think I'm boring my dog here. My dog, his name is Neo. He was sitting with me. He just walked away. He's like, this is too boring. I don't care about efficient frontier. Anyways, yeah, so square root. He was like, what is this idiot doing talking to a computer the whole day? I'm sure that's what he thinks about me. He thinks there's so many cool things we can do in life. We could have played in the garden. I could have taken him for a walk, but all that this guy likes to do is sit and talk to a computer. Anyways, yeah, I've thrown in a square root button here. I've thrown in a square root function here. Okay. So does it look all right? Yeah, I think the formula looks all right. Is there a bracket extra? Doesn't look like. Yeah, I think there's a bracket extra. You're right. There is a bracket extra here. So okay, let's bracket this. So okay, seem to be ready. Let's hit enter button, and there you go. We have standard deviations available for the whole range, and double click on it, and control shift percentage. Someone on the chat box says this formula I can impress the ladies. If you try doing that, Bob, you probably never dating for the rest of your life. Don't try it. It doesn't work. Trust me, it's coming from someone who tried a lot. Not useful. Okay. All right. So we have standard deviation of the whole range ready with us. Now let's kind of put some free space here so that we can navigate the data a little better. Okay. What I want you to do is, those of you sitting and doing this, trying to do this on the calculator, I want you to give it a try yourself. Okay. So we'll pick one scenario. Let's pick a 1090 scenario. I want you to do this on your Texas calculator. Okay. Just for the fun of it, just see whether Excel knows how to do it. Okay. So let's fire up the calculator here. So I have the Texas app. I'm going to do the same math. I want each one of you to do this along with me. Okay, so here we go. First, point one is the weight one. Come on, everyone, do this with me. Get your fingers busy. 0.1 multiplied with 0.0714. How did we get 0.0714? That's a standard deviation, is equal to x square. Okay, so the first term that I'm getting 0.000005, something like that. Store it in the first memory slot, STO1. Okay, let's do the second one. 0.9 multiplied with 0.07 equal to x square. 0.9 multiplied with 0.07 equal to x square. Now I'm getting 0.0039. I hope you guys are getting the same. STO2, storing it in the second memory slot. And let's do the last part of it. So let's sing the song. 2 into 0.1 into 0.9 into 0.0714 into 0.07 into 0.3380 equal to STO3. Okay. And then what are we going to do? We're going to add up the three. We are going to add up the three terms. RCL1 plus RCL2 plus RCL3 equal to under root. And I'm getting 6.5757 something, which our Excel has happily calculated to be the same number. If I increase the decimals here, you'd see that it's exactly the same. It has to be. Right? It's the same number. Okay, so that is how standard deviations are being calculated with this Excel formula. And even though, when you start doing this for the first time, it looks overwhelming, but I promise you, you spend a little time on this, you would master this area. You would have no difficulty whatsoever. Just write the formula a few times, practice it, you should be okay. Now, is everyone comfortable with what we've done so far? Are we together? Is it making sense? People on YouTube? Vishal, Shikhar, Geo Finance, Sindhu, Sarthak, Shrev. I hope you guys are learning. You guys are understanding what's happening. Okay. All right. Now, next, once this is done, step number 2, to calculate returns of the portfolio. Do I need a fancy formula for returns? No, right? What we need to do with returns of the portfolio, just do a weighted average. A weighted average, not an arithmetic average. So how will we do it? Observe. I'm writing the returns formula. Observe. Is equal to weight of the first asset. All those people who are struggling with calculator, keep it on hold. I'll answer when I open up the floor for questions. Okay, so don't spam the chat box. Just be a little patient. So weight of the HDFC Bank multiplied with the returns. Okay, this Zoom panel is obstructing it. All right. The returns. Wait a minute, guys. Okay, some bugs in my Excel. Let me do it. Yeah, I'll probably have to unfreeze the panes. Just a minute. Okay, let's unfreeze first. All right. So is equal to, bracket open, weight of HDFC Bank multiplied with return of HDFC Bank plus weight of Asian Paints multiplied with returns of Asian Paints. Do you think I should freeze something here? Yeah, I should freeze what? I should freeze the returns, right? Because when I copy paste, otherwise, for example, I'll just show you what happens if I don't freeze. Okay, so if I just hit the enter here, okay, and if I copy paste the formula, what happens is the way Excel, formulas work is it will understand that I have to take the adjacent weights and then see it is taking the standard deviation. If I copy paste it one more time and see what it will do, it will take these columns. You get the point, right? That's why it's important that we need to freeze it. So let's freeze C2 and D2, C2 and D2, and let's extrapolate the returns for the whole range. And there we go. We have the returns available for the entire set of the portfolio. Okay, I've just converted that to percentage, and there we go. And there we go. We have the risk and return profile of all the 300 portfolios. How cool is that, right? So we just had 2 stocks when we started. Now from these 2 stocks, we've created 300 hypothetical portfolios. And now we're going to select the best one for the client. So when the client pays you the fee, he knows that it's worth it because you are actually putting in the efforts to figure out how this, what is an optimized weight risk return quadrant here. Okay, I'll take you there slowly. So this is the return formula: weight into the return plus weight into the return. Weight into return, and just freezing the returns so that it's easier for us to copy paste. Okay. Now what I'm going to do next, and we kind of reaching very close to the objective of the session. I'm going to create a graph. Okay, what kind of a graph? I'm going to create a graph where I want to plot the risk of the portfolio on the x-axis and return of the portfolio on y-axis. And what's your intuition? What do you think? What do you think would be the shape of this graph? Traditionally, we've been taught that higher the risk, higher the return, right? We've been taught that as the risk increases, the return increases. That's what we've been traditionally taught. However, you would be kind of completely shocked or completely amazed when we actually plot this data on the graph, and you'd see that this risk return profile now is going to look a little bit different. Okay, so let's do that. It's going to be a lot of fun. Gear up. We're reaching very close to where we wanted to reach. It's very simple. I'm going to select the standard deviation and the return of the portfolio. And I'm going to try and insert, I don't know, what should I insert? I'm going to try and insert a simple curved scatter plot. So not a line chart. I want X and Y to be put it in a particular way. So I'm going to insert a scatter plot. And here you go, guys. We have a graph which looks a little bit like this. And this, my dear friends, this which looks like a C, which looks like a bullet of sorts, right? Some people would say it's concave. This, my friends, is called, in the world of portfolio management, this is called correct. No, this is called minimum variance frontier. Okay. Now, when Harry Markowitz built it, and when you use a proper optimization software, it uses a slightly different algorithm, but it will produce more or less the same result. Okay, and I'll explain to you why it's called minimum variance frontier a little bit later. Okay, so what I have tried to do is I've tried to replicate and simplify the process of building a MVF, a minimum variance frontier. I'll be calling it as MVF. by simply creating hypothetical portfolios. Okay. Now this graph is really intuitive. Okay, this graph is going to give us a lot of insight about which portfolios we should select for the client. Now let's look at this graph. Let's study this graph a little more carefully. You're going to have a lot of fun. Observe now. Okay. What do we have on the x-axis of this graph? What do we have on the x-axis? X-axis is risk, right? So this is risk. And what do we have on y-axis? We have returns. Now let's say that we have a client who says that I am okay with risk of about 10%. Okay, so let's say we have a client who says that I think I'm okay with risk of 10%. So we say, okay, for 10%, let's see what portfolio we have. So it looks like we have two portfolios. Okay, we have one portfolio here and we have one portfolio here. Okay, let's call this as portfolio A and portfolio B. Now you're the advisor of the client. What would you recommend him? Would you recommend A or B? Obviously B, right? You'd recommend B, is that correct? B. Is that, are you saying B? Yeah, correct. Yeah, of course, you would be out of your mind to recommend him B, right? B is stupid. Why is B stupid? Because A and B, if you can see, both of them have more or less the same level of risk. They have the same level of risk, but B offers you a return on y-axis, right? Roughly about 1.5 or 1.6, whereas A offers you almost 2%, right? So any person who's of rational mind would never select a B. He would always select a portfolio, and that kind of makes sense, isn't it? That it gives you a better return. It gives you a better return for the same level of risk. Do you agree? And can I say the same logic works for, let's say, a portfolio C and D? If you have to choose between C and D, what will you choose? You'll always choose C because it gives you more return, correct? Now imagine if the client comes to you and he says, you know what, I don't care so much about return, but I'm very worried about risk. Give me the portfolio that has the lowest possible risk available here. Give me a portfolio that has the lowest possible risk. Which portfolio would you recommend him? Correct, you'd recommend him this bullet point, isn't it? This point, right? Because this is the farthest on the left. We cannot go in terms of risk, we cannot go on the left of it. This is the lowest that's possible. So this tip of the bullet. Okay, so let me clear this mess a little bit here. This tip of the bullet here, okay, this tip of the bullet, this was given a name by Harry Markowitz. This tip of the bullet is called, GMVP. What is GMVP? This is global minimum variance portfolio. Sounds fancy, right? But forget the word global. That's an academic thing being thrown in. Look at the word minimum variance. What is variance? Variance is father of standard deviation. So standard deviation squared is variance. So obviously when your standard deviation is lower, variance would be lower, right? So the portfolio that has the lowest standard deviation, global minimum variance portfolio, minimum volatility portfolio, minimum standard deviation portfolio, this. You cannot construct a portfolio using HDFC Bank and Asian Paints, which will have a risk lower than that. Okay. So can we go and identify that portfolio? Yes. How will we do that? We'll just start looking at, the standard deviations, right? So this is the column that we want to focus on. Okay. So this is the column that we want to focus on, and we want to search for the one that has the lowest risk. So we can use a minimum function, but let's do it manually just for the fun of it. Okay. So look at the standard deviation. 12, 11, 10, 9, 8, 7, 7, 7, 7, 6, we're still benefiting. 6, 6, 6, 6, 6, 6, 5. Risk is reducing, risk is reducing. And I think 5, and then we start going towards 6 again, right? So it looks like our global minimum portfolio is somewhere here. Let's increase the decimals a little bit more. Let's increase the decimals here to see which one is actually lowest. We'll do it up to 4 decimals. Of course, we can always use a minimum function, but I'm just kind of trying to have fun out of it. So we have to go in that 5 range. Okay, so 5.83, 5.79, 78, 78. Okay, 783, 0, and then 7841. Does it look like the one for you? Do you think this is the minimum one? What do you say? Yeah, this looks like one, right? Because what happens is up to this we are decreasing, and then after this we start increasing. So this looks like the minimum one. Now, if I just simply run a minimum formula on this, okay. If I just run a minimum formula on this, so let's see what we get. We'll get 5.783. Is that the same number? Let's do a true function on it. Yeah, it is. So we do have the global minimum variance portfolio. All right. So now imagine client comes to you and he says, see, Utkarsh, I have done a little bit of work, or I've been told by my friends or my advisor or my equity research analyst that I have to buy HDFC Bank and Asian Paints. Okay. You take the historical data and you tell me, out of my 100,000 rupees, how much money should I put in HDFC and how much money should I put in Asian Paints so that my risk is minimized? I'm not talking about return. I want you to give me the lowest possible. I want you to give me the lowest possible risk. That is your job. That is why I'm going to pay you your advisory fee or your consulting fee. You do this exercise and you tell him, sir, the way to minimize the risk of these two stocks is by investing 49% of your money into HDFC Bank. That means out of your 100,000, park 49,000 into HDFC Bank and park 51,000 into Asian Paints. Because in our world, based on what our teacher, my teacher taught me in CFA FRM class, this portfolio is called Global Minimum Variance Portfolio, the lowest possible standard deviation. Sir, for your information, this is also tip of the bullet, right? If you go and talk to a client like this, he'll give you a tight slap on your face and he will start searching for other advisors. You don't talk to clients like these, but just out of your intellectual curiosity, this is the GMVP, and this is in row number. This is the portfolio number 140. Okay, so let's go to a graph. Where did that go? Okay, it's here. So let's go to our graph and write down here that GMVP is portfolio number 140. Okay, so that for ease of reference, GMVP is portfolio number 140. Okay, so first piece is solved. We know what GMVP is. Now, would you agree that we can do this for 4 or 5 companies, we can do this for 50 companies, we can do this for, we can do this for 100 companies. I mean, of course, not. It will be difficult on Excel, but it can be expanded to any number of companies. I told you, I do have a video on YouTube that explains how to do portfolio standard deviation calculation using matrix algebra. So you would need the variance covariance matrices. You can do it for as many stocks that you need. Okay. Now, guys, come on, let's focus here. You tell me, this minimum variance frontier is kind of broken down into 2 parts, right? So think of it as part above the GMVP and part below. What do you think are the smarter set of the portfolios? When you invest, do you want to invest in the part above the GMVP or the part below the GMVP? The upper section or the lower section? Obviously, you want to go in the upper section, right? You would say that, see boss, it's very simple. I will be stupid if I invest in let's say the black shaded region. I don't want to invest in black shaded region because that's kind of stupid portfolios. I want to invest in this. I should have chosen the color wisely. This interesting looking color. I don't know what should I call it. So I should be investing only in this glittery galaxy blue color. And my dear friends, this glittery galaxy blue color that you see, one of the reasons why Harry Markowitz received a Nobel Award in economics, which is kind of the award, in the history of mankind of sorts in a way. The reason why he received is this glittery galaxy blue color line, which is called, this is called the efficient frontier, right? The name kind of tells you that this is the efficient part of the portfolio, right? Efficient frontier. So obviously, as a rule of thumb, when a client comes to you, you never advise him to invest on black part of the portfolio. You want to always advise him to invest on this glittery blue part of the portfolio, right? So this is your efficient frontier. Thank you, Ayush. It's also called, he's right, Ayush is right. It's also called Markowitz frontier because he built it. So it's the Markowitz frontier. And going forward, I might simply refer to this as the EF. Okay, so we simply call this as the EF. Neha, it would always be concave. It will always be bullet shaped for certain reason. We'll go there. Okay, step by step. So anyways, so can I identify out of these which portfolios are efficient and which portfolios are not efficient, right? Is there a way for me to figure out which portfolios are efficient and which portfolios are not efficient? Very simple. I know that all the portfolios that give me a return higher than GMVP, because see, it's above, right? Y-axis is return. So all the portfolios which give me a return higher than GMVP are efficient portfolios, and the ones that give me return lower than this are inefficient portfolios, correct? So let's go to that portfolio number 140. Okay. And portfolio number 140, how much return you're earning? You're earning 1.82. Let's increase the decimals a little bit. Okay. So let's increase the decimals here. You're earning 1. I think we'll need decimals for the entire section. Five decimals should be okay. So you're earning 1.87. No, that's not 140. Yes, Utkarsh. Sorry. Yes, Bob will be doing that. Here. Okay. So here the return is 1.82374. Now, all the portfolios that give me a return more than that are the efficient frontier part, and the ones that give me less are the inefficient frontier part. So you tell me, should I go in the down direction or should I go up from here? Like, where am I earning more returns? Look at this. Every portfolio above this is earning more return, and every portfolio below this is kind of earning less return. And the more I go down, the more negative returns I start having, right? So it looks like this entire range, which is above, right? This entire range, which is above the yellow shaded region very soon. That's a gross color. The light green shaded region. Okay, these are my efficient portfolios. This is the part of my efficient frontier. Okay, so efficient frontier, this entire section, right from here to here, here to here. Okay, this is now crazy level of unzooming. This is my efficient frontier portfolios. And all the portfolios which are below this are obviously the inefficient portfolios, right? So this section This section here is the inefficient portfolios. We never want to recommend clients to invest into this set because they're just mathematically unoptimized, right? Clients are earning less return and they're taking more risk. They can definitely deploy that money into better combinations. So let's give them a, I don't know, what color should I give them? Let's give them a black. Let's say no to them. Okay, so let's give them a black color. All right. But obviously, if they give them a black, that's going to be a problem. So let's find a solution. Here we go. So these are your inefficient portfolios. So now let's look at this in practice. This is so much fun. If the client comes and says, you know what I'm thinking, client is thinking that I would put 46 here, 54 here. Should I do it? Yes, do it, no problem. But I'm thinking I should do 56 here and 44 here. Should I do it? No, don't do it, because you'd probably make more money by taking the same level of risk if you just move into some other portfolio above. Are you following this? Don't invest in combination of 56 and 44. That's an inefficient combination. It's giving you higher risk. It's giving you lesser return. Rather invest into some combination which is in the green region, because you would earn better returns, right? And how cool is that? We've basically been able to create 300 portfolios out of just 2 stocks. Teenso portfolio, we created 300 portfolios of 2 stocks. And then we've been able to conclude that, see, roughly about 140 of them are smart combinations, and roughly about 160 of them are stupid combinations. Don't go there, right? This is where you want to park your money. These are the combinations that you want to exploit. And the story doesn't end here, because in tomorrow's session, I'm going to teach you how to select a single best, smartest portfolio, even within these 140s, right? So right now we've identified that black is a no-no region. We don't want to do black, but obviously green is a yes region. But all of these are good players. But is there like a smartest player even within these 140 guys? Is there one portfolio which is like the smartest combination for that client, which wants to optimize the risk return quadrant? We would be learning that in tomorrow's session. Okay, and if you've I hope you enjoyed the session today. Those of you who came to learn, who not necessarily writing CFA exams, but who came to learn how to build efficient portfolio, I think all that you need to do now to be able to build efficient frontier on Excel is simply select this green quadrant, right? Just select the green portfolios, because these are the efficient ones. Okay, select, and stop at GMVP and put them on scatter plot, and there you go. This is your efficient frontier to be built in Microsoft Excel. Did you have fun? Yeah, me too. This is interesting, right? Will tomorrow's session be broadcasted on YouTube? No. Tomorrow's session will be the usual Zoom session that we do. For YouTube, we just decided that we'll do the portfolio management up to the efficient frontier. So that was the plan, and I was planning to finish it by 7:30. It got delayed by 30 minutes, but that's kind of all right. Okay, so here's the agenda now. For next 10 minutes, I'm going to take queries on today's class. Whatever doubts you have, just raise your hand and ask, or throw them on the chat box. And once some of those queries are answered, then we're going to end the YouTube streaming. And then I'm going to open up a AMA session, Ask Me Anything session, where I want to discuss, answer whatever queries you have, but I also want to discuss some sort of study strategy of, how to study for CFA level 1, how to study for FRM part 1, how the classes are going to be, especially those people who've come in for the first time, feeling a little overwhelming, with this. I'll be trying to answer some of those queries so that you feel comfortable with this process. Excel file, yes, let me share the Excel file right away. So on YouTube, this Excel file would eventually be uploaded in the description section. We'll probably put some sort of a link there, so you should be able to download it there. Just a minute. Okay, so start raising your hands. Let's start taking some questions on this process. Feel free to ask anything within the context of the session that we did today, so that we have a structure to the query. We'll start with Shantan first. Hi, Shantan.
Hi, Utkarsh. I wanted to actually ask something that is a bit of a general doubt, but has to deal with portfolio management at the same time. So I was looking forward to the thing that when valuations are very expensive, are high, and not participating doesn't seem like a feasible option, how would you go about dealing with life in markets? Would you like to take this now, or you can?
Yeah, actually, I'll quickly answer.
Yeah.
So
sure.
basically, see, this is not a this is a very individualistic question. I'll tell you my answer to this.
Yeah.
I'm putting you on mute. There's a lot of background coming in from your side. So here's my line to your answer. Okay, so I'm just going to throw a line at you. I prefer to, let's zoom this a little bit just to kind of create a dramatic impact. I prefer to, like this, and this is personally for me, it's not an investment advice, or it's not even a strategy, but this is just works for me. This is my answer to you. So basically, the thing is, in markets like these, right? No one knows what's the peak, like in today's market, and at times market can remain in overvalued territory for years, which means it is quite possible that the bubble would further blow up to such magnanimous size, and the valuation and the stock prices will keep on rising. So for me, this is how I look at this. Obviously, will I put in a massive chunk of money in 1 month in the markets today? No. But will I start selling stocks in my portfolio? No. What I generally do is I use a cautious hedging approach. Depending on what I feel about stocks in my portfolio, especially on the equity side, I decide what percentage of the portfolio I need to hedge. I generally make use of the put options. But again, that's for some other day. Let's switch back to the relevant questions only for today's session, so that we have a structure to the discussion. If you have questions in the context of what we did today, please raise your hand. I'll try and answer them. We'll start with Raj. Yes, Raj.
Hello.
Hi, Raj. Yes.
Yes, sir. I just wanted to ask that when we took the expected returns, so it is the same as the calculated previous year returns, or we have to assume anything, like in general?
So here in this context, I just use historical returns,
Yeah.
but you can always calibrate them to your expectation. So you feel, you've run your models and you feel that maybe HDFC should be 3 and Asian Paints should be 2. You can do that. Even the standard deviations. Here I calculated historical, but there are a lot of volatility forecasting models. You can also forecast them for more future oriented sigmas. That's also doable.
Okay, so yeah, clear. Thank
you. Sahit.
So could you show how you constructed those two graphs again? Like my line is a little different, especially.
It will be different because of the scaling effect. X and the Y axis. It's
Okay.
like a graph
Yeah,
would
I
look
tried
different if
to
you stretch your
access, but it says something like
Okay, so make sure that standard deviation column is on the left hand side and return column is on the right hand side. Okay, that's a condition because by default Excel will take sigmas on the x-axis, the left column on the x-axis, and the right column on the y-axis. Okay, so that's condition number one. So you check if your data has that. Does it have that?
Yeah.
Okay.
Yeah.
Then all that you need to do is just select the data. Okay, so Control Shift right arrow, Control Shift down arrow will select the whole data in one go.
Yeah.
And then go to Insert, and you would find a scatter plot written there.
Yeah.
Okay, now there are different ways of doing scatter plots. Choose the one which is curved rather than you choosing the one dotted. Choose the one which is curved, so it looks what we want to
Got it now. That's exact. Yeah. And so one more question I had was in real life, how different is this analysis compared to, if a client comes? I mean, what other factors do we consider?
This theory, look at this in the context of, the column, the year in which it was built, right? This is 1960s we're talking about. So obviously, there's a little bit of theoretical tilt to it. Harry Markowitz is kind of smart in a way. He called this as modern portfolio theory. So even in 2020, we still have to call it modern portfolio theory, though it's not so modern anymore. A lot of improvements have has happened to this, and now we have stuff like Black and Litterman model, a reverse optimization model, and then we have this corner portfolio concept. So we've plenty of improvements. So think of it as when the cars were manufactured, right? So prior to that, there were horse carriages, and then Ford came up with Model T, the first ever car. And today we have Teslas and God not what's coming next. But the principles, the basic principles are same. So even in today's portfolio management world, especially for high net worth clients and large ticket size portfolio, this process is still put to use. We relax certain assumptions. For example, in practice, it doesn't make sense to have such negative weights. So we can constrain the efficient frontier not to have negative weights, right? So we can throw in another condition into optimization process, or we can simply say, I will not select any portfolio which has negative weights. I will select only these, these bunch of positive weight portfolios, right? From portfolio number 91 to portfolio number 91 to, whatever 140 or portfolio. So I can only take the positive, set of portfolios. That could be one. Second, can I bring in multiple asset classes into it? Yes. So there are processes where I can throw in equity, I can throw in bonds, I can throw in even real estate, alternative, private equity funds. So I can build an efficient frontier for the entire portfolio also. One big challenge with this efficient frontier portfolio management processes, and you'd learn that, especially in CFA level 3, it's extremely sensitive to inputs. For example, imagine I build entire efficient frontier and I recommend to the client that, sir, you invest in this portfolio. Okay, hypothetical 12 and 88 because it's a good portfolio. And then next day, one analyst in my company comes to me and he says, Utkarsh, you have made a wrong assumption with HDFC return. It will not be 1.76, it will be 4%. And the moment I change this one number, okay, the moment I change it to 4%, everything in this portfolio is going to change. Everything, including the client's allocation to different asset classes. So next day I will have to call the client and I'll tell him, sir, there was a assumption glitch yesterday in my model. I fixed it, changed the portfolio. But the client will kick on my rear part because the client will say, Utkarsh, changing portfolio is not changing a cell on Excel. I have to sell and buy. There would be tax implication. There would be transaction cost, right? There will be skill cost to it. So these are some of the limitations we face in practice, but nothing that we can overcome. It's actually a very, very useful tool. And at advanced level, even large sovereign funds, sovereign fund means large value funds managed by the governments and large asset houses, they do this type of exercise with some modification for their clients, especially high net worth clients.
Okay. And so one more thing, so now in this table, it shows that the highest returns of the portfolio comes at minus 90% weightage for HDFC. So is that assuming that we're going to short sell HDFC, or
Yeah.
is it just
A negative weight means we're short selling it.
Okay, so we are assuming that we earn the same return even in case of short sell. So
yeah, because we are putting in more than 100% into Asian Paints, no? So whenever you have negative 90 here, it's like you have 100 rupees. So you do negative 90 short, you do 90 worth of short on HDFC. So that 90 will give you that extra margin of plus 90, and then you put the whole 190 into Asian Paints. So the reason why you're getting highest return is because you have more than 100% weight in Asian Paints, which mostly is a theoretical, situation. At least in the long run, you cannot carry a, short. You should not or would not want to carry a short position forever.
okay, all right. Thank you, sir.
Okay. All right, guys. So with this, thank you very much. I'm going to end the streaming on YouTube now. I hope you guys enjoyed the session. The Excel file should come up in some time, so you should be able to download. Thank you very much and good luck.